There's never a dull day in the financial sector, whether it's private banks or NBFCs. There's been a host of news flow. To get some perspective on some of the more recent news flow, we've got with us Suresh Ganapathy, Head of Financial Sector Research at Macquarie. Suresh, it's lovely to have you here.
Pleasure, yeah.
Like I said, never a dull day.
Yeah.
I'm actually going to start with private banks and then go on to the more hot topic of NBFCs.
Sure.
You have an interesting note out on ICICI. It's interesting. So we have these private banks, the guys who cleaned up and are now sort of on the mend at different paces, some quicker than others. And then there are, some which are still facing their own share of troubles. ICICI, from what you have interacted with the management and what you've said in your note, seems to be on a reasonable path of mend?
Yeah. Okay, so if you were to look at what exactly happened in 2009, they went through a retail crisis, and post that, retail has been behaving pretty well for them, right? So that was quite a watershed moment for them where they had to take a course correction and did pretty well with respect to restructuring the retail portfolio, moving more towards secured assets. And I think the last 4 or 5 years obviously has taught them a lot with respect to the corporate loan portfolio. And I think going forward, what happened with respect to retail, we expect something similar to happen on the corporate portfolio. So I think if you were to look at, for example, even in the recent NBFC crisis, they haven't had exposures or a direct credit exposures to some of the beleaguered names in the NBFC sector, right? So they have put filters in place, and I think the management is quite aware what needs to be done on the corporate portfolio. And I think with both retail and corporate sorted out, we are in for a new ICICI if you were to look for the next 4 to 5 years.
So, the initial sort of impression that came out from the management commentary, whatever they made at results times, etc., was that they will now largely stay away from project risk.
Correct.
But I think your note suggests and your interaction suggests that they're going there, but they're going there in a slightly different approach.
Okay, so they are going to be more focused towards projects which have established promoter credibility or track record. They're not going to take undue risk or large concentration risk, so they have absolute concentration limits being put in place. And look, also what's exactly happening is that earlier a particular borrower used to have credit taken from 25 to 30 banks in the system. Now, obviously, we don't have that many good banks in the system who can actually be in a position to provide credit, and it's really turning out to be a big nightmare. So when they are consolidating credit, that is, they are focusing on only top 4 to 5 banks, eventually the market share shift is happening towards the private sector banks like ICICI, Axis of the world. So the industry may not grow at 15%, they may grow at only 10% odd or so, but then ICICI can capture market share and grow at 15%. So they will be selective, but there are enough opportunities in the market to be selective and also grow your corporate loan portfolio, at least for these well-capitalized private sector banks at 15% odd.
But they didn't see the kind of management churn that other banks where there have been troubles have seen.
Correct.
So, one problem was that, okay, if the management churn is not there, then does the same culture live on and hence the same problems come up?
Yeah, I think that's quite a valid concern, and a lot of people have raised that. But to a great extent, it also depends upon, how well the guy at the top can actually direct or, take the bank in the right direction. So if you were to look at previously, I don't think there was specific operating profit target which was defined by Chanda Kochhar, which is not the case with Sandeep. Sandeep Bakshi is very clearly telling that every business is going to be assessed on the aspect of risk-adjusted operating profit, which is an excellent metric to look at. So you can clearly see, Sandeep Bakshi has also come and completely dismantled the designation. So there is no AGM, DGM, and all those kind of typical bureaucratic hierarchies which exist in public sector organizations, right? So he's trying to do a lot of changes, and I think it will take at least 3 to 4 years for us to get reflected in that culture. But then I think I don't necessarily believe that you need to have a whole set of new management to change. I think sometime a leader at the top itself can be quite influential and change and improve. Sandeep Bakshi did pretty good job in ICICI Prudential Life, right? It was a reasonably well run company during his tenure, which had a good stellar listing and stuff, and it has done well, except that of course there has been a cyclical issue with respect to that company. But then, yeah, so I do believe that he has the capability to do something good about ICICI and change.
And you have
culture.
A buy on the...
Yeah, it clearly remains the topic. One has to look at it in this way that today HDFC Bank trades at a massive 100% premium to ICICI. Right? If ICICI is trading at 1.6, HDFC is at 3.5 odd or so, and that's the valuation gap which can narrow. So though ICICI has done very well over the course of last 12 to 18 months, I think there is more room to read it. As long as the delivery happens, the ROE improves, the credit cost starts coming down, I think market will be happy to lap onto the stock.
So I've seen a couple of your notes where you asked the question, who's going to be the next HDFC Bank, Axis or ICICI? Axis seems like they're a little bit ahead in the cleanup. You know, the management reshuffle has happened. Amitabh seems really confident. Are they slightly?
Possibly slightly ahead, but then if you want me to answer that question, who is going to be the next HDFC Bank? And I think I would say just wait for 10 more years. I mean, it's going to take
a long time.
Yeah, I mean, it's going to take a lot amount of time. You know, one area where we had indistinctly trying to do some analysis here was that the biggest difference between HDFC Bank and others, if you were to look at their, you know, the so-called DuPont analysis, which we very use as a framework for analyzing the entire financial sector per se, is that they have very high risk-adjusted margins. That's a model which is very difficult to replicate. You know, I mean, it's not easy to do high risks in retail lending, at the same time manage your credit costs. So that is going to take a lot amount of time to seep into the culture and trying to build that kind of a model, and that's going to be the biggest challenge for all these organizations, especially in an environment where everybody is turned risk averse. If you speak to an Axis, if you speak to an ICICI, they say, oh, we are only going to do AAA, AA, single A lending, so where are you going to get your margins up? You're already done very well with respect to your cost of funds, and there is pressure on cost of funds also, right? So the only way is you get an yield pickup, and getting an yield pickup is not easy when in an environment where you are becoming incrementally more risk averse, right? So.
Also for Axis, you probably would you need something like an acquisition or something to, you know, chart growth from here on, or do you sense that they will continue with their sort of slightly above industry kind of growth
So
rates?
small and marginal selective acquisitions here and there is fine, but a big bang acquisition, like for example Kotak acquiring an ING, that's going to really push I would say the return profile into a distant future, because what happens is that integration pains are always going to be very, very difficult. So, you know, there are speculations about the fact that whether Axis can acquire a public sector bank if it is available at the right price, assuming the necessary legal amendments are there. I mean, the culture differences and all is so huge that integration will be a massive challenge. I don't think inorganic way is the way to go about building your return profile or your future trajectory of growth. It has to be largely organic in my view, because the available candidates in the market are not that great enough for you to go ahead and acquire them.
Sure. Suresh, some of the more recent trouble spots, have you been disappointed with what's happened both at Yes Bank and at IndusInd Bank? One didn't expect some of these, sort of issues with structured lending, etc. to come up, or at least one didn't know that they existed.
Yeah, I mean, of course, Yes has been a big disappointment, and I myself have admitted in my note that it's been a big mistake. Yes, we underestimated the pitfalls of structured lending, and interestingly, when we were speaking to the corporate banking head at ICICI, the RBI rules are very clear on structured lending and promoter financing. When you're financing anything at the promoter level, that has to be backed necessarily by a good amount of cash flow. Now, what exactly happens in a holding company is that there is no cash flow. There is no operating businesses, so they have holding companies which are operating businesses, but then that underlying itself is also weak, and the only way around the holding companies to service that there is through the dividend model. So just purely because you have some additional shares being pledged as a collateral, then that becomes a collateral dependent lending rather than a cash flow dependent lending, which is what went to some extent awry with both IndusInd Bank as well as Yes Bank. So I think people have really realized the importance of really assessing the risk based on cash flow rather than purely on the collateral. Just because you have 2x collateral doesn't necessarily mean you go ahead and lend it, because recoverability becomes a big challenge. If the stock prices collapse 50% and 70%, you are in a big problematic state. So yes, it's not an easy business to do it, but what exactly happened was that in the pursuit of high valuations, and of course HDFC Bank and ICICI is being very active in the retail market, the only extra uptake came from structured lending. So clearly they were taking high risk, also meant high reward, but then when the risk fructified, clearly they have been caught off guard. So I think going way forward, they have to be a bit more careful towards this, and yes, they have to reorient their business models. Yeah.
On Yes in particular, so obviously they've been in the headlines, lots of churn at the board level, at the management level, and I see the immediate issue that there is unsettled sort of environment within the bank, but slightly more medium term it's good, right? I mean, because the previous management and the previous sort of overseers got us into this trouble. So if all of that is getting cleaned out and a new set is coming in, medium term it's good.
Possible, but then it takes a lot amount of time to clean up it. I mean, one cannot expect a CEO who's been 7 weeks in the organization as having cleaned up the entire bank, right? So I think there's more pain to come. Clearly, over the course of next I would say 2 to 3 quarters, you can see more realization of some of the so-called watch lists that they have come out with. So that remains a challenge. And I think, 5 board of directors resigning immediately after Rana Kapoor quitting, and all of them quitting because of personal reasons, apparently looks something quite suspicious. So I am a bit more reluctant, to be honest. So there is a price support here at 115 rupees perhaps, or 120 rupees where the stock is. There is a price support. So to that extent, yes, from a valuation perspective, one can argue it's fine with Yes Bank. But clearly from a business model perspective, do you think it can really do very well? I think it's quite difficult as of now to take a very positive or a convincing stance on them. And also you have to understand that Ravneet Gill comes with an experience of being in a foreign bank for 25 years. Now things are quite different. Running a mass market private sector bank in a country like India is very different from being a CEO of a foreign bank. So challenges are quite plenty on his plate, and I seriously doubt execution capabilities, specifically in case of Yes.
So immediate risks are timing of capital raised, price of capital raised, growth, and still some of the structured lending, ADAG exposure, DHFL exposure.
Yes, that's true. Yeah? Those are all of course a risk which is going to be quite palpable in case of Yes Bank. And as I said, clearly reorientation of their entire business model. See, scaling up the retail franchise is not going to be easy. Pralay Mondal moved from HDFC Bank and Yes Bank, and I don't think much has been done in Yes when it comes to its retail portfolio, right? Both on the assets as well as on the liabilities front. So, and the competition for retail liabilities is just getting tougher and tougher. You know how difficult it is to operate with so many payment banks in the country, small finance banks, and of course the existing private sector banks, and deposit growth is very difficult to come by. Yeah. So the real problem with Yes Bank is their ability to scale up liabilities franchise in a hyper competitive market. That's going to really make the entire task much more difficult. Not specific to Yes Bank, it is a challenge for all of these smaller banks also. But then that's the need of the hour for them, because only when you have a solid funding franchise, you can go on to lower risk loans. Otherwise, then your margins go for a toss big time, right? So these things would take a lot amount of time. So the course correction is not going to happen in a couple of quarters. Easily, you'll have to give 3 to 4 years, and investors need to have a lot of patience for that. I mean, why should I buy the stock for something where the returns could be quite back-ended, right? So far into the distant future.
Sure. More broadly for banks right now, Suresh. So what is the upside and the downside? The upside could be that the NPA cycle has finally turned. NPAs were down FY19, but the downside could be that there are new risks, whether it's DHFL, etc., in the NBFC space or promoter financing.
Yeah, but then these are not as large a risk as compared to the SRs and the Bhushans of the world, right? So to that extent, you will still have a scenario where you will see improving profitability. But what is going to happen here is everything is with respect to expectations. So everyone is factoring in a recovery with respect to the banks, right? Whether it is SBI or BOB or for that matter ICICI and Axis, and everybody has an improving ROE in their model. So eventually, what could happen is that there could be downside to that expectations. So we are not disputing the fact that the worst is over, but the extent of improvement could be worse than expected.
Because of the new risks or because of the slower recovery?
Both. Because of the new risk, and finally we will touch the issue on NBFC liquidity crisis. That's creating a credit squeeze in the economy, and economic growth is obviously getting affected. If there are not much jobs growth, you can also already see to some extent the auto sector being in quite a bit of a turmoil, and auto loans not necessarily doing very well. HDFC Bank had a decline in the auto loan portfolio last quarter. What I'm arguing is that these risks can inhibit the recovery, and therefore eventually the numbers across the banks, right? So, or for that matter for the market also, right? Everybody starts off the year with a strong 25-30% earnings growth for Sensex, and then eventually you'll end up coming into lower teens, right? And exactly that's already happening. The earnings estimates for consensus were very high for 30% for market, and now it's already come down to 20% after the fourth quarter numbers, right? So that's the risk. Yeah.
Point taken. Okay, NBFCs.
Yeah.
Plain and simple, how extreme is the risk in NBFCs right now?
I think there is a lot of fear mongering which is going around. There is risk in the system, but it is not a systemic risk. I do believe that the NBFC risk is quite isolated. So there are 2-3 large cases which have a problematic, which have problems in fact. But then if you were to look at the large ones like say an HDFCs of the world or Shriram and Mahindra, I think one thing, Ira, which gets missed in this is that I would see a very serious systemic risk only when there is an issue with the end user segment, which is basically your borrower. What exactly is happening is that if the borrower is in a position to repay you the money, you can take the money from the borrower and pay your lender. You may not be in a position to give an incremental disbursement to your borrower because your lenders are not willing to give you money, but they can remain liquid, you can remain solvent by deciding not to grow, right? So growth could be an issue. Profitability could be an issue, but not necessarily systemic risk, assuming your borrowers are paying on time. No, is a Shriram Transport borrower defaulting because of the liquidity crisis? There is no as such liquidity issue on the borrower level. The borrowers are still paying the money, everybody is paying their EMIs. The real problem could be in those NBFCs who have a larger exposure to the real estate sector where there is an issue with the borrower. So there if the borrowers default and if you're not getting an incremental funding from a lender, then you are going to be really stuck up. So therefore the risk is isolated. So NBFCs who are financed, say, large developers or on the real estate side or say loan against property, those guys will have an issue, but not necessarily the usual retail guys. So what could be the eventual fallout of the NBFC crisis in my view is couple of cases here and there which can go bad and eventually lower growth and lower profitability for the NBFCs. But I don't see the entire system going down. That's very clear.
So this risk on the, you put it very well, so the risk on the customer side end is largely in the HFCs because those are the guys who have lent mostly to the developers?
NBFCs have finance loan against properties. So it's not only HFCs, NBFCs also have their real estate division. So a lot of NBFCs, for example, do finance real estate developers also in one form or the other in a circuitous way, right? So both NBFCs as well as HFCs, obviously HFCs by their very nature, clearly they are only into mortgage market, would have financed a larger amount of developer portfolio. In fact, we had done this analysis, both the NBFCs as well as HFCs put together. In the last 5 years, have financed 85% of the incremental credit flow to the real estate sector. 85%. Only banks have financed only 15%. And I said real estate sector, I'm not talking about the mortgages.
No, just the developer loans.
The commercial real estate, developers, lease rentals, all those kind of developer loans that you're talking about. That's 85% on an incremental basis. So that's where the risk is. Maybe those NBFCs could have an issue, not that all the other NBFCs will have an issue. But as I said, everybody has an issue of growth and profitability, right? So, yeah.
So the problem will then start showing up on the asset side as well, not just on the liability side, if some of these developers, etc., actually start defaulting.
Of course, that's true. So to that extent, banks have taken an exposure to such kind of developers will have an issue with respect to incremental NPLs coming from there, from that segment. So that was earlier the risk not factored in, but then clearly say the next couple of years, if there are some defaults from that NBFCs, clearly some of the banks which have lent to that will have some NPLs. But as I said, none of them are as large as obviously the SRs and the Bhushans of the world. So it is only the extent of recovery and expectations which go for a toss. The magnitude goes for a toss.
On the liability side, two parts to my question. One, between September and now, have some of the NBFCs and HFCs managed to reduce the liability risk, reduce CP borrowings, etc. So that, has that improved a little bit? Two, if it hasn't, is there still some sort of systemic solution required?
No, so if you were to look at it, incremental funding for the NBFC still remains a challenge. It's better compared to what it was pre-September, during the September crisis. But then to a large extent, what exactly is happening is that the funding is concentrated on few large NBFCs, right? So clearly people with good promoter groups like an HDFC or an LIC or a Bajaj are in a position to raise money. But nevertheless, the debt markets are no longer as liquid as it used to be, and you would have seen obviously today the HDFC mutual fund taking a big hit on their portfolio. So I'm pretty sure that the investors into the debt mutual funds are not going to come anytime soon. So they do fear, and I think when the flows into the debt funds are going to really be quite anemic, it's going to be an issue with respect to funding for all these NBFCs. So most of them, the way they have managed the last 6 months era is they have gone through the securitization route. So they have got rid of all their good pools. So the banks have been in a position to cherry pick. So clearly what is going to happen is that in the next 6 months you're not going to find that kind of good pools to securitize. So the only way you can say solvent is by not lending.
And is there any market out there for these developer loans, etc.? Small.
very small, and
investors.
it's a tough market. It's not a very transparent market and stuff. So I'm not sure whether banks can easily. For example, if you were to look at, for example, when you met the corporate banking head at ICICI, she very clearly said that the portfolios that they have bought are all retail portfolios, pure retail portfolios, and they could even cherry pick. So maybe a Dewan or Indiabulls retail portfolio absolutely doesn't have any issue, at least in several pockets, but I don't know whether people will be open buying their developer portfolio. So to that extent, yes, the risk does remain for some of the non-banking financial companies.
And this polarization in the NBFCs is not just in the bond markets, in the banks as well, right? I mean, I heard some incidents of Bajaj Finance wanting to raise some money and them getting, 10 times of what they actually wanted. Right. So even banks are just going to the
that's true. So even banks are going to go towards good quality credits. Even today, people with good promoter backing, banks are happy lending to those NBFCs. So see, India has 11,000 NBFCs. I'm pretty sure a lot of them have to die eventually, right? So there is no space for that much amount of NBFCs in the segment. And there's a long tail. So clearly you can see some of the long tail disappearing over the course of next couple of years.
Two more questions. So one is, do you have a sense of how much growth has fallen off in terms of fresh disbursements from the NBFC space?
We had done a rough analysis. I think the last quarter, if you were to look at it, the disbursements were down 25-30%. So, the outstanding AUM growth can still show 4%, 5%, but that's misleading because it's a function of repayments and prepayments and stuff. But then disbursement growth is really weak, 25-30% down.
Oh, really?
Yeah.
Okay. So then there is that the fear that it's hurting the economy is very real. So then there is some justification to ask the central bank to open a window or not?
That's a thin line that you can move on. I mean, my view here is that I'm like a pretty conservative guy, so you cannot create a moral hazard in the market saying that, look, I'm willing to bail you out. So central bank is of the view that there isn't any big systemic risk, and if business models have to evaluate and some of them have to die, let them die. But then opening a liquidity window sets a very bad precedence. I still believe the situation is not that bad enough to open a liquidity window, but yeah, it's a very tough call, to be honest. Yeah, but I would not recommend opening a liquidity window, because I don't think the situation is that systemic in nature, which is trying to be which the market is fearing at this point in time. Yeah.
Last question, and I'm sorry, I feel sad this is the last question because this is 70% of our banking sector. Yeah. But is there any interest in PSU banks right now, even the larger ones like SBI, etc.? Do you think there's,
I mean, let's look at it in this way, right? From 1990s to 2020, in the last 30 years, the PSU banks have lost 30% market share, and I think that process is going to only get accelerated over the course of next 20-30 years. So you may lose actually 20-30% market share in the next 10 to 15 years. So why would you get into institutions which are going to lose market share? There are serious structural issues with respect to, say, the average age of workforce is 50 plus. There are no structural reforms which are happening there. Plus, there's a big consolidation risk. I mean, though it is good for the system in the longer run, for a shareholder who is trying to invest in some of these public sector banks, there's a massive risk by the fact that they are going to actually acquire much weaker public sector banks. So clearly they will go through a prolonged period of pain. There is a cyclical recovery even in them, but then at best these public sector banks are trading best. They just cannot be investment ideas at all over the course of next 5 years. Government has no business to be in business, in my view, specifically the way the banking system has been run over the course of last 30-40 years, the public sector banks. So yeah, there are a lot of challenges.
All right, I'll leave it on that note. Suresh, thanks so much for taking all of our questions. Gamut of Financial Services. Thanks so much. Thanks for watching Bloomberg Quant.